Manpreet, let me start off with your view on precious, because we are taking a look at this chart on the BTV terminal, taking a look really at how far this recovery rally for gold and silver can go. We're seeing this relative to other commodities hitting the upper limit of the downtrend channel. At this point, are gold and silver still the best inflation hedges?
Well, for the time being, we think it's one possible hedge, at least for sort of short-lived sort of rises in inflation. And the reason for that is when you think about the drivers of gold, we still think one of the best indicators of what gold will do is, what we call real bond yields. So in other words, what bond yields do net of inflation. And, one support for the gold rally recently has been the fact that, inflation has been rising, but bond yields have risen by a lot less, pushing that real yield lower. So look, we think this, of course, could continue in the short term at least. We're of the view that the current inflation rise is largely transitory. But, gold we still think one good sort of allocation to have in an investment portfolio, because if we do get an upside surprise in that inflation pushing sort of that real yield lower, gold should be, the most direct beneficiary of that.
Yeah, fourth straight session of losses for the dollar, and of course supportive would be the lower dollar environment as well. Do you expect that to continue? Have we hit somewhere close to a bottom when it comes to the greenback?
Well, you're right. A weaker dollar would also support most sort of commodities, but gold as well. But no, we don't think the dollar sort of fall is over. We're still bearish on a 6 to 12-month horizon, and it comes a lot back to the same point about bond yields. Except, of course, for currencies, what matters is relative bond yields. So today, of course, we've seen sort of bond yields net of inflation fall in the U.S. But as the economic recovery gathers pace, particularly outside of the U.S., we may see that gap between sort of bond yields in the U.S. And other major economies continue to widen to some extent. And that's the environment we think sets the stage for further dollar weakness. Now, a lot of that, of course, comes from the euro, purely because it's viewed as the default anti-dollar currency. But we think it's currencies like the Australian dollar, which should be quite leveraged to global growth. Those are an example of currencies that should benefit if we're right about a weaker dollar. And, of course, the pound sterling as well, which is valuation-wise a little bit more attractive.
Where does the Chinese yuan stand, given that we saw a huge rally since May of last year, but at the same time, when it comes to economic data, it seems a little bit more of a mixed picture these days?
It is absolutely, and I think that's because the direction of travel for monetary policy is a little bit different to what we're seeing in the Fed, for example. But the Chinese renminbi, we think should sort of see support in a weak dollar environment, and it's coming back to the same basic drivers. Bond yields, of course, in China are still, higher than what you can get in the U.S. And, even if nothing changes there, but we get sort of that continued move lower in net of inflation yields in the U.S., we think that should continue till the balance away from the U.S. dollar and towards the Chinese renminbi. So indeed, across sort of Asia, we think the Chinese renminbi, along with the Korean won, they are, we expect those two currencies to be amongst the key beneficiaries of a dollar-weak environment in the next 6 to 12 months. A lot of that coming to the difference in bond yields, and of course for the Korean won, the leverage sort of position to global growth, the U.S. and economic recovery in particular.
What other economies will really benefit, markets will benefit from the economic recovery in the U.S., especially with more stimulus, whether it's monetary or fiscal?
Well, from an asset class perspective, I mean, we actually, are quite bullish on equity markets. When you think about an economic recovery, possibly one that's accompanied by a little bit more inflation than before, that's an asset class we think that still has scope for gains ahead. And the reason I say that over, for example, credit, we still think pockets of credit will do well. We have a strong preference for dollar-denominated credit, whether it's Asia or EM more broadly. But the thing with equities is, unlike credit, the upside does not appear as capped, particularly if earnings continue to climb, which is a little bit different to credit, where spreads have already tightened. So the gap between the yields on credit and the yields on treasuries, it can only narrow so far. So that's where we think the big beneficiaries will occur. Of course, region-wise, we still think the US and possibly the UK, more because of unusually attractive valuations there. Those, of course, being the key metrics. But of course, we're keeping a close eye on Europe in particular, where news has been bad. But if we see a turn in sort of sentiment, that's a market we keep on our radar screens, at least in the coming months, if data changes.
China's top economic planner is telling its steelmakers that it needs to diversify sources of iron ore. How much of that is a real risk for the rally in the Aussie?
Well, one can debate, I guess, over the very long term. But for the time being, what matters is what the immediate sort of price action is, and we've seen that very much in iron ore, as well as other key Australian exports like gold. So while the sources might very well be diversified, at a global level, the demand for commodities like iron ore is likely to remain in place, and we think that is likely to be a sufficient tailwind for the Australian dollar. So of course, China is an important market, but that source of demand, along with other major global sources, should remain in place. So that's why it is a risk to keep in mind, especially when taking a multi-year view. But to us, the global demand picture should be sufficient.
Manpreet, we started off talking about inflation hedges. Is Bitcoin a viable inflation hedge for you right now?
That one would be a struggle. I think when you talk about inflation hedges, I think because the real bond yield channel we discussed earlier, gold sort of seems to serve that purpose well. The thing with Bitcoin is that there's not actually that strong a correlation between gold and Bitcoin. So while that's one sort of relationship that's often cited, we don't quite see the relationship between the two variables. In fact, if anything, if you look at cryptocurrencies like Bitcoin, we tend to see more relationships with liquidity and sentiment. So absolutely may very well have its own place, and it's an asset class I'd be very, very careful with. But for a direct sort of hedge against inflation through the channel of real bond yields, I very much prefer gold because it's much more proven on that relationship.